This video will demonstrate one of several different methods that is commonly used to determine the fundamental value of a home. As with any investment, the owner would like to earn a return on investment that is consistent with the underlying level of risk. This is commonly done by calculating the return on investment, which is the money earned as a percentage of the total amount invested. Let us consider a hypothetical example. The price of a home is $120,000. This home, or another home that is similar in size, quality, and location, can be rented out to a tenant for $1,000 per month. This means that annual rent is $12,000 per year. The return on investment in this case is 10% per year, which is calculated by dividing the annual rent by the price, or $12,000 divided by $120,000 times 100 equals 10%. Investors often calculate the inverse version of this value in order to determine the price-to-earnings ratio of their investment. The basic price-to-earnings ratio in this case is 10, which is calculated by dividing the price by the annual rent, or $120,000 divided by $12,000 equals 10. To be more thorough, any other costs involved in obtaining this investment, such as transaction taxes or legal fees, should be added into the price, and any mortgage interest and property taxes should be subtracted from the rent amount in order to figure out the true price-to-earnings ratio. Some investors will then subtract the country's inflation rate from the price-to-earnings ratio, in this case bringing it from 10 to 8, assuming a 2% inflation rate. According to many savvy real estate investors, a home is not worth buying if the final price-to-earnings ratio is 18 or more. From the seller's perspective, it would often be considered not worth selling a home if the price-to-earnings ratio is less than 14. Many informed real estate investors therefore gravitate towards buying or selling homes at a price-to-earnings ratio between 14 and 18 under normal market circumstances. When the ratio for most homes in a city is higher than 18, this is often referred to as a seller's market, which means that the sellers are at an advantage. When the ratio for most homes in a city is lower than 14, this is often referred to as a buyer's market, which means that the buyers are at an advantage. Please note that this method of valuation is only one of several methods that one can use as a basic guide to figure out the value of a home, and it is not intended to stand alone in determining a price. There are many other factors that will determine a home's value, such as supply versus demand, transit infrastructure, interest rates, neighborhood income levels, future prospects, future population growth, the pervasiveness of property speculation, etc. Also, many home buyers are willing to tolerate a high price-to-earnings ratio because they intend to live in rather than rent out their home. Occasionally, excessive levels of property speculation can drive prices so unsustainably high that real estate investments become extremely risky, and this is referred to as a housing bubble. In order to help mitigate against potential swings in home prices, one helpful rule of thumb is to keep your total housing costs less than 30% of your gross household income, and to keep your total debt costs less than 40% of your gross household income. Due to the sensitive nature and high level of risk involved in real estate investments, please consult a licensed financial advisor and local real estate professional for more guidance that is specific to your situation.